So day one is going to be where we'll talk about glossary. We'll talk about vehicle types, which I'll explain. We'll talk a lot about risk. We'll talk a lot about risk. Importance of starting early. We'll talk about low fees. I'll kind of go over the history and the data of markets going up in the long run, and some investing strategies, and we'll talk about lump sum investing and dollar cost averaging. So that should take at least an hour because I do talk. And please do ask any questions if there's anything you don't understand, if you want me to expand upon. This is going to be the investing basics. Again, I'm going to try to sort of build up and give you information. In these sessions, you're obviously not going to be ready for Wall Street or anything like that, or Bay Street if you're for Canada. But I'm hoping to kind of get you started. So let me say, first of all, I did receive a grant to cover some of the costs for this presentation from small grants, neighborhood small grants, Vancouver Foundation. So thank you very much for that. If you're local to Vancouver, you can reach out to them and you can apply for a grant as well for if you're doing something for the community, which I'm hoping I am here. So the goal of the presentation is give you basics of investing in personal finance, cover some simple investing strategies. It doesn't have to be complicated. Compare different vehicles and account types, look at taxation. I think the reason I'm here is I'm hoping to get everybody excited about investing, give you some nuggets of knowledge if you're already investing and if you know what you're doing. But I've had the privilege of becoming financially independent and not having to work for a living and being able to live off the passive income. And I would want everybody to have that because it's improved my life significantly. So in the third session is financial independence and sort of how to get there, what approach to take. So from these sessions, I'm hoping you'll know how to begin investing, know the basics, be motivated to start investing and to start educating yourself further. I find this stuff super interesting and it's gotten me to where I am. I know not everybody finds it that fascinating, but you know, I can blow this up a little bit now. Every time I see somebody squinting, I'm like, is it too small? So, you know, I'm hoping to sort of get you interested, and then you'll have to sort of take it from there. So we are going to be covering different ways of investing in different asset types. And what I want you to be doing while we're going through this is to start thinking about what you would like to use. If you're not investing right now, or if you are, see maybe if there's a better asset type for you to use. So, you know, you may say, hey, I really have no interest in this, but I still want to retire, you know, at a reasonable age. So maybe a financial advisor is the way to go. I believe 95% of the people can do it themselves and they don't need a financial advisor. But if you don't have the time, you don't have the inclination, just doesn't interest you, then I mean, that might be the way to go. The other way, of course, is discount brokerage, and that's sort of what I'm sort of gonna sort of head towards. So choosing which brokerage is going to be important because what you want is to have as little fees as possible in your chosen strategy. And so you need to sort of figure out the strategy that you're going to go with. And according to that, choose a brokerage, choose the account type, and then choose your strategy. Okay. You also need to choose, do you want to use exchange traded funds, which if you hadn't heard the word before, I'm going to go through that, or mutual funds? Are we going to do RSPs or TFSA? Are you going to be doing small monthly purchases or large lump sums? So that's the strategy part. To anybody who's here thinking this is going to be a get rich quick scheme, it's not. So my net worth, which I've publicized, is about 4.7 million, give or take, Canadian right now. It took me 20 plus years of working in IT to get there. Like it didn't happen. It didn't happen overnight. So Jason, I see you have a hand up. Do you want to type, or shall I unmute you?
I was actually congratulating you, like,
Oh, okay.
nice net worth.
Yeah, no, I appreciate that. Thank you. It's you know, it took a little bit of a little bit of work, obviously. I did work in IT. I don't know how good this camera is. I do have some gray hair, so you know, it definitely took a toll. I had a goal of becoming financially independent and not having to work anymore. And at the end of my career, I was investing 85% of my income and living on 15%. So it depends what you want from your life. And I'm going to go into this in the third session in the financial independence piece. But it really depends on what you want from your life, what your goals are. If you want to enjoy life now, have a boat, go on vacation, then you know there's an opportunity cost to that. So but I'm not gonna tell you to invest in this and you know you're gonna become a millionaire overnight. That's not what I do. I think most of you are here from TikTok, so you can find people on TikTok who will try to sell that to you. Anyways, that's not what I'm here for. Okay, so some caveats. This is not investment advice. It's for educational, entertainment, and demonstration purposes. I'm not trying to get you to buy or sell anything, let alone any securities. I've been an investor for 20 plus years. As I've said, I use mutual fund stocks, real estate, and private equities. I'm probably fairly risk friendly, and I'll delve into what risk is in about 5 minutes. I personally like emerging markets in the long run. That's sort of my strategy, high level aim. Everybody should have their own strategy. So I do run a YouTube and TikTok channel. Everything's called Canadian Money Talk, and I do some blogging and so on. So feel free if you like the content to jump on there. Eventually, I do want to teach investing and personal finance, both to adults and high school and college students, because I think there's a lack of financial education in Canada and US as well. People get out of school and they don't know how to start. They don't know how credit cards work and so on. And again, thank you to the sponsors, and do reach out to them if you've got something good for the community, local to Vancouver. Okay, so let's do a glossary first, just so we know what terms I'm using. Okay, so stocks or shares or equity are all synonymous. They mean ownership in a company. They may pay a dividend from its profits back to the investor. Okay, so bonds, the difference here is that it's a loan. It could be to the government or it could be to a company, and it pays interest. So they're kind of getting at the same thing two different ways. One is ownership, the other one is a loan. One can pay dividends, the other one pays interest. And those are sort of the primary vehicles a lot of people tend to use. The vehicles, as I'll get into later, are real estate and stuff like gold and so on. You might have heard, if you're an investor, especially with a financial advisor, you might have heard of asset allocation. This is how a portfolio is divided between stocks, bonds, and other assets. That's all it means. It's a really long word, just basically how you allocate your money. Interestingly enough, it's the most important factor in a portfolio return. It doesn't seem to even matter that much which stocks. It just matters whether you're in stocks or you're in bonds. Now, something I'll refer to a lot, so I want to make sure everybody understands, is an index. It'll also be a benchmark for a lot of investments, but an index is a representation of a stock exchange. So I'm sure everybody's heard of S&P 500, which is the Standard & Poor's 500 biggest companies, American companies. The Toronto Stock Exchange uses the TSX. So if a reporter on TV or whatever says the TSX was down today, it's very likely they're referring to this index. It's used as a benchmark for other vehicles as well and represents the market. Okay. So a mutual fund, which is going to be one of the ways that we can invest, is basket of investments. It could be stocks, bonds, real estate, gold, cash, all sorts of stuff. Now, a balanced mutual fund, the word balanced means by definition that that mutual fund has stocks and bonds. That's what the word balance means. The other major category that we can use to invest is exchange traded funds, which is also a basket of investments. It's very much the same as the mutual fund. It's just done a little bit differently, and I'll get into that in a couple of minutes. Now, both of these, both the mutual funds and exchange traded funds, have a management expense ratio, which I'm going to call a MER. So that's the percentage of assets that you, as the owner of that asset, pay to the company that put out that mutual fund or that exchange traded fund. You never see it go. It's not on any statement. They just sort of take it off and they adjust the share price of the ETF or of the mutual fund. This percentage is on an annual basis. They could take it out monthly or quarterly or what have you. You don't really notice it because the share prices are moving on their own, so you don't really see anything happen. So the mutual funds and the exchange traded funds, they can be actively managed. There's very few actively managed ETFs, but there's most of the mutual funds are actively managed. And that's where a human makes the decisions about which assets to include. And then passively managed is the asset is mechanically directed by some sort of a formula. It could follow an index. It could be stocks in a given sector. So you can have an energy ETF, and that's just going to have the major oil companies. And then depending on the ETF, it could have some of the renewable resources as well. But it just follows a given sector. There could be other rules. The company has to be this big and it must have had a profit in the last 2 quarters, et cetera, in order to be included in that ETF or mutual fund. But it's because there's no high-priced human making the decisions, they tend to have lower MERS. Okay, so I'm going to pause here for a second. Everybody sort of good with what we have so far? Good? Okay, perfect. So now turning to the markets a little bit. So a correction in the market is when the stock market is down 10% from a recent top. A bear market is when you have sort of a downtrending market. I sort of remember it using bear down, which my baseball coach used to yell at me when I was pitching. And that's when you're down 20% from a recent top. So currently, as of October 18th, we have The S&P 500 is back down into a bear market, and the NASDAQ, I don't think ever came out of the bear market. So we're down significantly from the recent top. Bull market is the opposite. That's an uptrending market. Generally 20% up from a recent bottom. It just depends on who you ask, but bull market basically means up. Okay. I want to get figures of a bear and a bull, but whenever I looked for them, they seem to be $300, and I want them, but not that much. So that's the markets. Okay, these three figures refer to the markets. The next two refer to the economy. So a recession is when the gross domestic product, which is the value of all the goods and services produced in the economy, has decreased 2 quarters in a row. It's a little bit more than that. There's actually an academic body in the U.S. that announces that the U.S. is in a recession. Just because you're down 2 quarters in a row doesn't mean that it's automatically a recession. You could call it a technical recession. And actually in Canada, we haven't had a negative GDP quarter yet. But so anyways, 2 negative quarters, okay? And a depression, generally GDP's decreased more than 10%, or a recession that's lasting more than 2 years. Like, we haven't had one since the 1930s because the central banks fiddle with things in order to keep us out of a depression. But a recession is, it just happens every so often. I believe every five years you get a recession, sort of on the average. So a brokerage is a place, usually online, where you can transact stocks, bonds, mutual funds, etc. Discount brokerage is basically you get no financial advisor. You make all the decisions yourself. And that's generally the way I would suggest you would go for you to start your investing. Capitalization, or cap, is the worth of a company, where you just multiply the price per share by the number of shares. And so mega caps are 200 billion plus, largest 10 to 200, mid is kind of 2 to 10, small is 300 million to 2 billion, micro is 50 to 300, and nano is under 50 million. So generally people will sort of use large, mid, and small. They won't go into the others, but if you want it divided up more finely. Okay. You would think, hey, company's worth 50 million. That doesn't sound small, but relative basis. There's what is it? Apple, Microsoft, and Google are over $1 trillion. And I think there's Saudi Aramco is over $1 trillion as well. So those are even bigger than mega. Okay, so that's sort of our vocabulary. How do you calculate cap? Yeah, so you take the price per share, or just what's the price of the stock, and you multiply it by the number of shares they have out. So if they're trading at $5 a share and they have 1 million shares out, then they're worth 5 million. That's the cap. It's a multiplication. Okay, so here's our sort of different vehicle types. So we're going to go over stocks, ETF, which I've mentioned, and I'm just sort of going to go over the passive ones, and then mutual funds, and I'm going to cover active and passive. Those are kind of your standard building blocks for your portfolio. So a stock, as I mentioned, it's a ownership in a company. It has a ticker. It's bought and sold on a stock exchange. Fees, you might have a commission to buy them. That commission is $0 to $10. So for example, Wealthsimple brokerage doesn't charge you any commissions. And then most of the big banks, discount brokerages will charge you $9.99, $10, let's say, depending. So it depends on the brokerage. So again, this is why you need to figure out, I'm going to be doing stocks, and so I need to choose this brokerage as opposed to a different brokerage. The fee could depend on the amount of assets you have with them and the trading frequency. So for example, Qtrade, which is one of the brokerages I use, if you have under $500,000, they charge you $875 per transaction. If you have over $500,000, it's $695. So now the pros of using individual stocks is there's no annual fees. Once you pay that trading commission, you own the stock, you don't pay anything again. The cons are you're not diversified. With most brokerages, Canadians are limited to US and Canada. Interactive Brokers, for example, lets you buy anywhere all over the world. Wealthsimple, you would probably just want to use for Canada, for example. So again, you need to know what you think you'll be doing, and not just tomorrow, but in a couple of years. So you don't end up having with 3 brokerages like I do, because that becomes a little harder to track. If I can make a suggestion to anybody who's beginning, please don't start with individual stocks. Please don't. The research and just it's not something you would start with. I would suggest exchange traded funds or mutual funds. But just with individual stocks, you need to buy quite a few of them in order to get some sort of a diversification going. So especially if there's fees, and especially if you're going to be doing it on a monthly basis, ETFs or mutual funds are much better vehicles. Just word to the wise. Okay. So exchange traded funds. So you buy shares in a bucket of stocks or other assets. Much like a stock, it has a ticker. Also bought and sold at a stock exchange. They trade during the day. The passive ones, as I said, will follow an index or a sector or some sort of characteristic. Same commissions usually in order to buy them, $0 to $10. Some brokerages such as Quest Trade will let you buy ETFs for free, no commission, but then they'll charge you to sell them. They will have a MER just to administer the, and I guess to make a profit. That MER could be, in the US, it's actually 0. In Canada, I think the lowest one you'll find is 0.05% through to 0.4%. If you find an actively managed one, they could be anywhere from 0.6, 0.8 and higher. Okay. You do get automatic diversification. So you could invest $100 in an ETF, and with that $100, you manage to get yourself exposure to hundreds of stocks. Low fees compared to mutual funds, definitely. And like I said, Quest Trade will let you buy ETFs, all ETFs for free. Each brokerage tends to have a set of ETFs that you can purchase without paying a commission. So the fees are a lot lower. They're passively managed. This is under cons. So Danny's asking, if an ETF has a yield of 3% and a MER is 1%, does that mean you only get 2% in dividends? No, I would say you would still get the 3% paid out to you. The money just shows up in your trading account, and then you can transfer it into your checking account to spend it. The MER comes off the share price. And like I said, you don't see it go. There isn't any statement item. So you would still get the full dividend yield, and the MER would come off the share price. Good question. So ETFs are passively managed. You could make a case that they will do poorly during down markets without a human adjustment. That's debatable. That's debatable, actually. Because they're usually following the index, they will not outperform it. They will just follow it. And in fact, they're going to be this much under it because of the MER. Okay. So moving on to mutual funds, which is where I think most people start off with when they go to their bank and they get a financial advisor and they say, I want to start investing. So you get into mutual funds. Two flavors. We'll go over the actively managed ones first. Same, you're buying shares in a bucket of stocks. Interestingly enough, they're bought and sold overnight, and their price is updated overnight and is based on the closing the closing values of its assets at the end of the day. But you basically set your trade up and then you buy or sell it overnight. And they have a code, usually 3 letters, 3 numbers. So something like MAW 108 or RBC 108, that kind of thing. Their management expense ratios, because they are actively managed, they end up being quite a bit higher because you have a portfolio manager and then you have research staff that he or she leverages. So you end up paying for that. And if you hold something for 20 years and you're paying, I think the average is about 2%, that ends up being a drag on the performance. There used to be penalties for early sales if you're using something called a deferred sales charge. That's been made illegal. But if you own mutual funds right now that have the letters DSC after the name, you can't pull the money out within 7 years of purchase. So same benefits as the ETF, diversification. You've got a human making decisions. Generally, there's no commissions to buy or sell them. Having said that, I had a whole bunch of mutual funds in my Q-Trade account, and about 3-4 months ago, they instituted where they were going to charge the same $6.95 for mutual fund transactions as well. So I don't do a couple $100 every month. Now I do bigger amounts. The downside is you do have high fees. This is kind of the highest. And Canada, by the way, is the worst. Like US is way lower. I think out of the G10, I think Canada is one of the worst. If you are using a salesperson, they do have a conflict of interest in that they will likely sell you what makes the most commission for them. Because out of this MER, let's say the MER is 2.5%, the mutual fund company gets to 1.5%, and then they pass 1% on every year as a trailer to the person that sold that mutual fund. That 1% is supposed to be for continued financial advice, rebalancing, which we'll explain today. Unfortunately, that doesn't always happen, but it is what it is. They often underperform their indexes, however. So that's why people get into ETFs, because the ETF just matches the index. The mutual funds, because of their fees, primarily, but also possibly because of bad stock picking, they will underperform their indexes. Over a 10-year period, about 80% of mutual funds underperform their index. That's why ETFs sort of came into existence. Okay. And then last is mutual funds, which are passive. They just follow a passive index. Everything is largely the same. The MERS, these probably are on the high side. They could like 0.3% for an index mutual fund would probably be the MER. Okay, you still get the diversification, still no commissions to buy or sell. So until Q-Trade instituted their charging commissions for mutual funds, I would use index mutual funds every month I would buy 3 of them. It'd be like $150 into one, 200 into another, and so on. Can't do that anymore, like I said. So Jason's asking why choose mutual funds over ETFs. Because you can find you can find mutual funds, the 20%, that will outperform their index. So not to jump ahead, but since you asked, here you go. Okay, so this is a screenshot from Morningstar, which is an independent research facility. Morningstar.ca is their website. So the blue is the investment. The yellow is the category. So that's other mutual funds that have that are global small to mid cap equity. And then the red is the index. So here you see the 80% down here, underperforming the index. And then you can get mutual funds if you research them, which is super easy on Morningstar. And that's the blue line. That's outperforming not only its peers by a country mile, but also the index. So if you want to go mutual funds, this one is also helped, and this is going to be in session 3, by the way. I know I'm really selling that session. I don't know why, just because nobody signed up for it. So this one is a do-it-yourself. So the MER goes all to the mutual fund company, and they don't pay any commissions to a salesperson. Okay, so the MER is probably 1% lower than the equivalent mutual fund would be if it had a salesperson. So that also helps with the performance. Okay. Good question. Gotta find where I was. Whoop. Okay. So let's talk about risk. If you have a financial advisor, he or she will give you 20 questions that will sort of gauge this. If you're going on your own, then you're, you sort of have to figure it out yourself. One thing I will say is everybody thinks they're super risk friendly when the markets are going up until they start dropping. And then everybody panics. Okay. So what determines your risk profile? It's basically your ability to handle volatility, up and down movements of the investment value. Risk isn't necessarily a bad thing. Volatility isn't a bad thing. It's just the difference between it going like this versus it going like this. Okay. So there's a couple of components. One is your risk tolerance. Are you able to handle the volatility psychologically? Like with my portfolio, like I'll be down 40,000 in a day, and it's just like it doesn't do anything to me. You can think of it in percentages if that helps. But if I actually thought about it and knew that like 40 grand was 3 months worth of work when I was working in IT, like I wouldn't be able to stay invested. But it doesn't bother me. So are you going to freak out when you get a statement or you log in? It's like, oh my God, I worked so hard for that money. So you have to judge that. And this is one of the components that will determine what sort of things you should be investing in. And I've talked to people that say, hey, listen, I can't take it. I want safe stuff. And I'm like, but you're going to give up some of the upside as well, which I'll show you in a sec. And they're like, no problem. I just want to be able to sleep at night. Okay. So that's the risk tolerance. Good gauges, can't sleep at night. Then you're in something that's too risky. The only problem is that by the time you find that out, now you have to wait for it to recover before you should get out of it, because you generally don't want to be fixing a ship in a storm, if you know what I mean. So ideally you do that soul searching or with somebody's help. you know, and say, hey, can I sleep at night? So that's one. Risk capacity. So are you able to handle this financially? Are you selling the assets that just dropped in order to buy groceries? Do you have other sources of income to be able to handle the downturns? Financial education also should increase the amount of risk a person is able to handle. So the more you know, the more comfortable you are with the volatility. And you know that in the long run, stock markets go up. It doesn't feel good in the short run when the market drops. And by the way, volatility is both up and down. Just nobody really has a problem when it's volatility up. People just hate when it's volatility down. So it just comes with the market. Jason saying there's a Rutgers University risk tolerance quiz. Yeah, there's a few out there for sure. For sure. So your financial advisor would give you a KYC. If you're doing it independently, it's know yourself. So your KYC is composed of the risk profile, which we just sort of covered up here. Time frame is super important. When do you need the money back? You will get into much different investments if you need the money back in a year versus if you need it back in 30 years. So if you're 20 and you're saving for early retirement when you're 50, you can be in super risky stuff because, as I'll show you in a sec, the volatile stuff outperforms. If you're saving for a down payment for something, for a vacation, for a house, whatever, and you need the money back in 6 months, I hate to tell you, it's a term deposit or an online high interest savings account for you, because you could get lucky and the market could go up 10% in 6 months, or you could get unlucky and it could drop 10% and then you won't have your down payment. So time is super, super important. For stock market, I would say 10 years would sort of be a safe way to go. 5 years would be minimum, and that's pushing it. Okay, just from my point of view. And then lastly, what sort of return do you need? And so this is where a financial plan, back of the napkin, Excel, whatever floats your boat, is something you should try to do, because why get into something super risky where maybe you won't be comfortable with the volatility if you don't need that much return? Like if you don't need 20% return, don't go into, you know, into the stock market. If you need 5% return, you can be in something far safer that's not going to make your head spin. So knowing the return you need is also the way to go. And so the risk time frame and the needed return is going to determine what portfolio you'll end up choosing. Okay. Any questions before I go on? Comments? Everybody's sort of good so far? I'll take a drink, give you time to type. Okay, cool. So this is just something I dug up. So rate of return and volatility / risk, they're hand in hand. Okay, the lower the risk, the lower the rate of return. So down here, I don't know if you can read this, but you know, what is that? Fixed income bonds, okay, is here, and then you have a little bit of stocks, all the way over to the blue is US stocks and the red is international stocks. So you'll get a high rate of return, but you'll also get high risk and high volatility. And then it just depends on the time frame. So some generalities: stocks are more volatile than other assets. Closer to home stocks thought to be less volatile. You could say that in the US and Canada, you sort of know the culture, you know what you're getting. you invest in further afield, and like it could be the wild, wild west, like Russia, obviously now an extreme example. But even prior to that, occasionally they would just socialize stocks, and suddenly, okay, this company is now property of the state, and everybody who had stocks in that company went to zero. So there's stuff like that. So closer to home generally would be less volatile. You sort of know what you're getting, maybe. So in that case, you would say Canadian stocks is least volatile, then US stocks, followed by international. Larger companies, all other things being equal, and their stocks are less volatile than small company stocks. But again, both up and down. So, if Royal Bank has a bad quarter, they'll drop 3-4% after their announcements. If they have a great quarter, they'll go up 3-4%. A small company, they have a bad quarter and they'll drop in half. But if they have a great quarter, or they make some sort of an announcement, then they'll double, like overnight, or during the day. So that's sort of where you have to make the decision for yourself. Do you want to have a good, and of course you can mix and match, right? You don't have to be all on one side. Bonds are generally less volatile than stocks. It still depends on what type of bonds. If you're getting bonds in some small Venezuelan company, not to pick on Venezuela, they're going to be riskier than, Manulife here in Canada, but generally bonds are safer. Also, if the company goes bankrupt, by the way, bondholders have a first shot at the assets of that company, while stock are pretty much last. So the more risk you're willing and able to accept, the more time you have and the more return, the more volatile your portfolio can, and I would argue should be. Volatility and return are correlated, as I've said. So if you need a large return to meet your goals, you will have to stomach the ups and downs more than if you need a small percentage returns. And time frame is important, and I think I went over that. So here's the 5 and 10 years. To me, again, just the type of investor I am, investing should be like watching paint dry or watching grass grow. If you want excitement, go to Las Vegas. Paul Samuelson. Jason's asking, what in your opinion is a long time for comfortable high risk? Well, like if you want to get into something that'll be quite volatile, then probably 10 years. Just because something's volatile doesn't make it a good investment, but it's just that volatility and return are correlated. Small companies can go bankrupt as well, so there's that. Okay, so this is sort of a catch-all. There'll hopefully be some interesting things in here for everybody. Equities in asset allocation rule of thumb. So you should have, this is just a rule of thumb, it depends on your risk friendliness, as I've said, but you should have 100% less your age in stocks. And some people would argue 120 less your age. So I'm close to 50, so I should have 70%, 50 to 70% in stocks, and then the rest should be in bonds. I don't think I have anywhere near that in bonds, because I've sort of made an adjustment. So this is sort of a good starting point. When you're calculating how much you need in retirement, you could, if you have a pension coming, you could think of that as risk-free income and sort of make adjustments in your portfolio for that. Another tool you can use is something called target date funds. This is a mutual fund that has, 2045 after it in the name. And that means that they're expecting you to pull all the money at 2045. And so 15 years out, they're going to be all equity, and then they're going to transition into less risky assets as years go on. So you don't have to do it. You're going to pay an extra MER for that, maybe 0.5%. But you won't have to make these transitions. So they'll transition from all stocks to some bonds, to mostly bonds, to all bonds, and then they'll transition into something called money market, which is very safe, but doesn't make you very much money. And they're at that point sort of expecting you to pull the money at that point. Okay. If you have significant equities, what you want to do is have an emergency fund. So if something bad happens, you don't have to sell equities to live on if they happen to go down. The emergency fund is supposed to be 3 to 6 months of basic expenses, depending on the type of job you have. So if you're a contractor, you might want to have 12 months. If you work for the government, you're probably good with 1 month of emergency fund. If you have a spouse who could carry the mortgage and the expenses, then maybe minimal emergency fund. The other cash you might want to have is, they call it dry powder, is if equities go down, you might want to have cash on hand to take advantage of it. Anybody who has cash today, they say cash is king. Most of the time, cash is underperforming everything, including inflation. But when the market drops, that's when cash is good. It just depends on how long you think you're going to want to sit on that cash, earning 2% while you're watching the stock market go up. So that's the other thing as well. So I did a video on the YouTube channel about the bucket portfolio. I highly recommend it. The reason we'll go through it is twofold. For people who are nearing retirement, a bucket portfolio is a retirement investing strategy. For people who aren't anywhere near retirement, this strategy will illustrate how the different types of assets work. Okay, so it's called the bucket portfolio because you have 3 buckets. Daryl's asking, would it better to have emergency fund in gold, silver? Good question. Gold actually isn't that stable. It's actually up and down quite a bit. So it's not safe. It's gold and silver to a lesser degree. They're sort of a fear investment. When stocks are dropping, people are selling out and they're either going into bonds or they're going into gold. So when people are afraid, they'll go into gold. But it doesn't mean that gold is safe, because like you will get large movements in it as well. I'm not a commodity person in general. I do have oil, but I'm not a commodity person. I would make an argument that gold doesn't have any utility other than like high-end electronics. Silver is actually better from that perspective as far as utility. It's used in manufacturing. But yeah, nor does gold seem to be great against inflation. But yeah, I mean, if you want gold in your portfolio, I mean, you can have 5, 10, 15% of gold. There's nothing, all right? It's your money. You can set it up however you want. But cash is liquid, generally something that you can access quickly. The emergency fund is a good way to go. Carrying, significant amount of cash just in case the market drops may not be the best use of it, because the market in the long run goes up. So, okay, so back to the buckets. So remember, this is a retirement strategy. And so bucket 1 you're supposed to have 2 years of living expenses in cash. Okay. The reason for bucket one is if your other assets went down, you don't have to sell them while they're down. You can live off of the cash from bucket one while the market is down and give it time to recover. You'll see later on that most down markets actually do come back within the 2 years, which is why you have 2 years. So Daryl, yeah, cash in a high interest savings would probably be best. I mean, these days you might get 2-3%. You can shop around, see if you can get a term deposit that'll pay you more. But if you have to pull the money early, they'll probably say, okay, you don't get any interest whatsoever. But yeah, the emergency fund is there to turn emergencies into inconveniences, basically. It's not intended to make you money, which in a savings account it won't. But it's safe, it's liquid, it's accessible. So the bucket one would be that same high interest savings account online, shop around, whatever you can get, right? Now, bucket two will be years 3 to 10 or 8 years of living expenses in high quality bonds and dividend stocks. And then bucket three is everything else is in stocks. So whatever your portfolio, if you spend 50 grand in a year, then you would have 100,000 in bucket one. You'd have 400,000 in bucket two, and then whatever else your portfolio was, that would be in stocks. Bucket three is going to be the engine for your portfolio. That's going to have the high growth, but it's going to have volatility. So what you can do is you can only get money from bucket one, and then you sort of let the money flow from bucket three to bucket two to bucket one. Not the best for taxes because you have a lot of transactions going on. If you want to use it actively, you can decide based on bucket two and bucket three performance, which bucket you want to live from. So if the stocks have just done really well, you can pull money from bucket three to live on. If stocks have done poorly, you want to be living from bucket one, hunker down and wait for it to come back. Okay. So on Morningstar, there's lots of articles about the bucket strategy, but it's and by the way, the buckets have nothing to do with TFSA versus RSP or anything like that. Those are just the types of investments. Okay, moving along swiftly. So I know you guys can't see this. I can't either, really. Whoop. Nope, other way. So this is an index chart. This was the latest one I could get. I have a giant one in paper on my wall, but it's even older than this one. So, okay, before I get into it, Jason's asking, how do you build up the buckets all at once or one at a time? Yeah, the earlier you do it, the better, because there's generally going to be tax implications as you're moving stuff into the buckets before you retire. So, the more years you can spread it out over, the better, because then you'll have just small tax hits and you can spread it out over multiple years. So that would be my suggestion. You could say, hey, I already have some dividend payers. That feels like bucket two. Then I have some growth stocks. That's going to be bucket three. I'm going to retire at 60. So when I start, so when I'm working, when I'm 58, 59, I'm just going to be saving up cash. I'm not going to be investing it. And that's going to be my bucket one. So, you can sort of work it that way. You can fine tune the amounts It doesn't have to be exactly 2, 8, and remainder. But so where I was gonna get, and if you can get one of these, I couldn't find one for sale. It has everything, including what down here is whether it was liberals or PCs that were in power, who was the PM, how we were doing against the American dollars down here, all sorts of cool stuff. This is the Canadian version, right? Oh, yeah, there you go. So the reason I bring this up is, can I move this over? Yes. Okay, so the reason I bring this up is this is illustrating the volatility versus return. So the dark blue line is US small stocks total return. This is over 67 years. It's 1950 at the beginning, and it's ending 2017. So over that 67 years, the small caps did 14% a year. Now, the next lower one, which is US large caps, they did this, the pale blue, they did 11.7. And then the red, which is the TSX, yay, Canada, is down here, and that did 9.8. Now, you can sort of come down and you can see at the bottom, you have a nice flat green line, which is, I believe, the 91-day Canada Treasury, which is a short-term bond, the safest of the safe, okay? That did 5.3, and that was when the interest rates were high. You can see how it's sort of flattened towards, in the last 20 years. So my point is, with the dark blue, you had a lot of ups and downs, but if you had the time, then you made 14% a year. If you don't have the time, you need to be in something safer. So that's sort of supposed to illustrate that. So the diagram shows the risk and return trade-offs. 1968 to 1974, for example, down here, the stock market really did nothing but go down. But that was just the small caps. You'll notice the large caps didn't really, well, maybe at the end a little bit there, but they didn't have anywhere near the volatility. So, that's why you mix your portfolio up. You're not only in risky stuff. And I think I mentioned the rest. Okay. Any questions before I go on? Everybody's good. We're at it for an hour, so I'll try to hurry up a little bit. Okay, so I sort of call this asset types. This is sort of how I see the world. We can have a debate at another time. Please form your own vision of the world as far as how you see things. So it's going to be, for me, it's going to be investment versus speculation versus gambling. Okay, this is how I define it. You could talk to somebody else and they would have a different definition. So for me, an investment is an asset that has a steady stream of income or cash flow. Examples would be dividend paying stocks, investment real estate with a positive cash flow, meaning you have money in your pocket at the end of the year, which I think is sort of hard to come by in Canada. And the value of the asset is determined by a series of cash flows. So that's an investment to me. Now, speculation. I know it sounds sort of negative, maybe. So that's an asset that goes up in price because somebody else places a higher value on it. So those would be stocks with no dividends, but making a profit, and the resulting price appreciation is happening because somebody else is looking and seeing, hey, it's making a profit, I'm going to buy it, and that bids up the price. So real estate with no positive cash flow, but it's appreciating because other people are bidding it up. That's the only way you're going to make money. Art, collectibles, same kind of thing, Bitcoin and gold. Okay, no cash flow in any of them, yet their prices, let's say, go up. So you could argue the value of any asset is determined by what somebody else is willing to pay for it. You know, like, why is one piece of art worth 100 times more than another piece? Is it that much nicer? You know, does it bring more pleasure? How much is a Pokemon card's actual utility? Like, it's not, but people are willing to put money on it. I would also argue that day trading and timing the market is a bit of a speculation, because in the short run, you don't know what the market's going to do. And again, you're using other people's money in order to bid up your own asset. And then lastly, we have gambling, asset that on the average is going to stay the same or go down, but may go up. So to me, that's stocks of companies that don't make a profit, may not get any price appreciation, real estate with no expected price appreciation. So if you buy, you know, a piece of real estate 50 kilometers from the nearest village, yeah, you could get lucky and there'll be a developer who's interested, but likely not. And get rich quick schemes. They're likely not going to make you any money, but they could. Okay. So that's sort of my view of the world. Like on the TikToks and on YouTube, I always say that's a speculation. I don't use gambling all that much because that doesn't seem to come up. Okay, importance of starting early. So this is the rah-rah portion. I'll go through this really quickly. This is all just math, just calculated. Start early. $1 invested for 40 years at 7% turns into almost 15 bucks. If you invested for only 10 years less, it's half. If you invested for only 10 years, it doubles. But generally, you want to let time do the heavy lifting on your portfolios. They say the best time to invest was yesterday. The next best time is today. Doesn't matter what age you are. You know, I wish I was 20 and investing. Actually, I sort of was, but now just note, initially you need to invest yourself and get an education so you can go to work, start a business, and you're going to be trading your time for money initially. But as you save and invest the money you earn, it'll work for you, and you want it to work as long as possible. So that's my pitch. Importance of low fees, very similar. $1 invested for 40 years at 7% turns into the 15 bucks. If you invested at 5%, meaning there was a 2% fee taken off every year, it's half. You would think it'd be proportional, but the way the curves sort of work, fees have a significant impact. But performance is what matters. And when we look at the prospectus for ETFs and mutual funds, it's always after the fees and MERS have come off already. So yeah, the fees are painful, but if you get into something that has good performance, that trumps the fees. You know, don't get into low fee stuff just to say, I'm not going to pay your fees, if you're missing out on something that could more than make up for the fees. So look for total performance. Okay, markets go up in the long run. So red is bad, green is good. This is the number of years. So the S&P 500 had -3 years between 0 and 10 negative, and it had 6 positive, and only 1 year where it lost between 11 to 20, 21 to 30, and 31 to 40. And it had multiple positive years in those same brackets. So the stock market goes up in the long run. This is over 92 years. There was a 60% return at some point. Okay. Same kind of thing, more green than red. Okay, so this is US, but Canada will be similar. History of bear and bull markets. So back in the 1930s, during the Great Depression, you had a bear market that lasted 2.8 years, 6 months, 10 months, 2.1 years, 11 months, 4 months, 2 years. This is where the 2 years in bucket one comes from, because the bear markets only last that 2 year time frame for the most part. Okay, but you can see the bull markets run for 4 years, almost 15 years, 6 years, 2 years, and so on. So markets go up. Why do markets go up in the long run? Now you have an increasing population, so more people spending more money. You have better technology and improved efficiency, leading to lower costs and higher profits. And if nothing else, you always have inflation to get higher revenues. And if you get into good companies that can pass the inflation on, but their suppliers have no power and can't pass their higher costs onto the company, then inflation benefits the company. So like you look at Walmart, for example, which has super high power over their suppliers. They'll raise your prices, but they're not going to pay their suppliers very much more. So they'll make more profits. So that's why markets go up in the long run. Okay. Another, I like the graphics. Don't be your own worst enemy. So the S&P 500 annually from 2002 to 2021 makes 9.5%. The average investor mysteriously makes 3.6%. Why is that? Because they jump in and out of the market. They bet on stocks, individual stocks, and they get fearful, meaning they sell out at the bottom, and they get greedy, meaning they buy at the top because they think they're missing out and that it's going to keep going up forever. So yeah, generally you should have a strategy and you should stick to it. Okay. Time moderates returns. So what that means is in 1 year, so green is stocks, blue is bonds, and then the gray is a 50-50 portfolio of stocks and bonds. So for the stocks in 1 year, 47% up, 39% down. For bonds, generally far more positive. Now in 3 years, the stocks are only down 3% over a 3 year period, and they're up 28%. And then once you get into 20 years, there is no 20-year period where stocks are down. Okay, nor bonds, nor so. This is where if you have a long time frame, you're actually de-risking yourself. So obviously we all have the time that we have, but just saying. Okay, we're sort of in a home stretch here for this session. So some investing strategies. Lump sum, if you have $5,000-$10,000, you buy an asset a single time for a larger amount of money, whatever that is for you. And that's called lump sum investing. If you can do that, you're fine. It's just that you're I don't want to say you're not diversifying, but it's just one of the strategies. What most people do is they use dollar cost averaging, where you buy an asset monthly or quarterly or whatever with the same amount of money each time. This is fairly standard. Therefore, if the market's gone down, you're buying more of it. So you're sort of hedging your bets a little bit. If you have the money, lump sum will be better, because if you're looking at an uptrending market and you're putting the money in over time, you're getting smaller and smaller profit, and the only time you'll benefit is when there's a downturn. So if you have the money, do lump sum. If you don't have the money, do the dollar cost averaging. it doesn't protect you against bear markets specifically, because your portfolio still goes down in the bear market, but you have the opportunity to buy more during that down market. And then when it recovers, you're looking good. And so it generally uses some sort of a pre-authorized payment where they pull the money from your checking account. So the money's withdrawn automatically and you don't miss it. This is a personal finance thing, because there's people who will spend money as long as they have it, and sometimes even if they don't. This way, by having it automatic, they're investing for their retirement, and then it's okay, I guess, depending on what goals they have for their life, to spend anything else that's left over. But if you spend first, this is the pay yourself first, right, strategy. If you spend first, you'll always have something better to spend the money on rather than investing. So by automating it, you're generally coming out ahead. So now, concept of rebalancing. So let's say that you, with the help of the financial advisor, or you did some soul searching and you said, you know what, I'm not really that adventurous, so I want to have some bonds in my portfolio. I want to go 60-40. I want to have 60% stocks, and I want to have 40% bonds. And so whatever money you have, you plunk it in, let's say 6,000 and 4,000 into the two. And then you also set up an automatic purchasing plan, and you do 600, 400. Okay. You let that run for a year. And then at the end of that year, your portfolio is guaranteed not to be 60-40 anymore. You have two different asset classes, which are actually supposed to not work together. So let's say you're now 70-30. So what you do, and you can do this every 6 to 12 months, there's no huge benefits doing it more frequently. Some people will have a trigger if it's moved significantly. So instead of 60-40, if it's now off by 10%, if it's now 70-30 or 50-50, then they'll rebalance. And so what you do is you return the portfolio back to the appropriate proportions by selling the assets that have the larger proportion of the portfolio than what you originally wanted, and you buy the ones that have the smaller proportion. It's not selling the ones that went up more, because they both could have gone down. It's just once it gets out of proportion is when you sell and buy in order to get back into proportion. So what that does is two things. One, it gets you back to where you were comfortable. If you were comfortable with 60-40, it gets you back there, because if you were 70-30, you're now more exposed. If there's volatility, that's going to hit you more than maybe what you're prepared for. And then the other thing is, as far as your portfolio is concerned, you're selling high and you're buying low. So that's sort of the idea. And actually, with the studies that I've read, rebalancing does have like a couple of percentage points, 2 to 3% a year, positive influence on your portfolio. So definitely do that. I've at the beginning of my investing journey, I've had financial advisors, and I swear there wasn't a single one that said, hey, let's fill out some forms and do some rebalancing for you, because it's extra work for them, and they never did it. So, I do it myself. Now, depending on the account type, rebalancing might be done by buying more of the one that is disproportionately lower, because if you sell, you might have capital gains if it was a non-registered, and if it was an RRSP or TFSA, you're fine. But if it's non-registered, you may have to pay taxes. So it might be better just to rebalance by pumping a little bit more into the lower one to get the proportion back up. So how this is sort of supposed to work is, you can think of those bonds as being your piggy bank. They're not gonna, as you saw from the earlier charts, the lines, bonds aren't gonna have huge returns, but they're sort of supposed to be the stable part of your portfolio. It's the stocks that are going to be volatile, but they're the ones that are going to have the big performance. So if the bonds are your piggy bank, you're at the end of the year, you're 70-30, you take a couple of percentage points off the stocks, you put them into the piggy bank. Next year, same thing. Take some profits off of the stocks, put it into the piggy bank. And then a day will come, my friends. We had one in 2020, where we're having one now, where it is time to crack open the piggy bank and rebalance the other way, because the stocks are cheap, and that's how you get the better performance through rebalancing. Okay, so that's sort of the strategy. Dollar cost averaging is completely standard. The rebalancing, like I said, doesn't seem to be done all that frequently because by financial advisors. I've got it in my calendar to look. To be honest, if I had a target of 60-40 and something, and if it was 65-35, I'd be like, meh, we'll leave it. But if it went to 70-30, then I'd be like, okay, let's sell off some of the 70. So that's sort of how far this is a natural stopping point. It's sort of how far I want it to get. I can keep going. We're hour and a half almost into it. You guys can ask any questions that you have about the material covered, whichever you'd like. Any suggestions? Keep going. Okay. Okay. So, okay. So Deborah's asking, can you explain why mutual funds have series? So very good question. It's the same mutual fund as far as assets goes, but then they have sort of different versions. The versions generally don't have anything to do with the assets. They have to do with fees. So you'll have series, and each mutual fund company names these things differently. There's very little standardization. So Series A, for example, might stand for advice. So what that means is they're the ones charging the 2.5-3% MER, and the mutual fund company gets 1.5%, 2% in order to make a profit and keep the lights on and pay the portfolio manager, and then they pay the rest to the financial advisor / salesperson. So that'll be an A. Series D could be for do-it-yourself. So they will have a MER that is 1% lower, and you can buy it through your discount brokerage, but your financial advisor won't buy it for you. Generally, they can't because their dealer won't let them. There's Series F, which stands for fee only. That the D is pretty common, and the F seems to be a standard one. The F stands for fee only, and if you have a financial advisor, and I'll get into this in the third session, if the financial advisor gets paid by a percentage of your portfolio, they don't get a commission from the mutual fund company. They charge you, let's say, 1% of the assets that you have with them. Then the mutual funds they'll put you into will be F series, which will have, again, lower MERs, probably just enough to pay the mutual fund company, because they don't collect the commission from the mutual fund company, they collect their payouts from you. There'll be other versions that has a $100,000 minimum, for example, and there'll be another series and so on, and I'll have a lower MER again. So yeah, so good question. So it's still the exact same funds. Well, same fund, the MER is different though. The MERS are different depending, like I said, if it's a do-it-yourself. Okay, you got it. All right, cool. If it's a do-it-yourself, they'll have a significantly lower MER. Okay, so personal oversight is just what most people do, meaning you're looking after it yourself. Lump sum and dollar cost averaging can both be personal oversight. If you're like, okay, I don't believe in the US anymore, I'm gonna get all out of US and buy Canada. That's sort of personal oversight. And Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. Super easy to do, super easy to say, really hard to do. When the market is going down, people just have a tendency to panic, especially if they haven't seen it. It always comes back up. It's a buying opportunity. It's just a question of when. So Daryl is asking, if I have 60% stocks, 30% bond and TFSA, then 1 year later I have 75 and 25. Can I sell stocks, buy bonds, and it all stays in the TFSA and tax-free? So yeah, both RSPs and TFSA, as long as it stays in that registered bucket, both TFSA and RSP are considered registered accounts, and all it means is there's some tax benefits. As long as the money stays in there and you don't pull it out into your checking account, with the TFSA or RSP, there's no tax implications. Okay. Yeah, good question. It's only when you pull the money out of your RSP, then would you get taxed on it. So basically what you want to be doing when you're managing your own portfolio, you have to sell when it's expensive, or at least trim some of your positions. So if something's just gone up like crazy, sure, could keep going, but professional investors have a strategy. So for example, the stock doubles, they sell a third. If it goes up another 100% of the original investment, they sell another third. Now they're playing with the house's money, and then they just leave it. But thinking that a stock is going to go to the sky and never come back down, like, you should be taking some money off the table. And of course, where that is depends. If you're running a mutual fund or an ETF, you should sort of keep an eye on it. But especially if it's a mutual fund, I don't think you really need to be making those sorts of decisions, because there's a well-paid portfolio manager making those decisions. With ETFs, because they're just following an index, yeah, you could say, hey, US has come up a lot, maybe I should take something out of that index ETF. Jason's asking, will we cover in any of those sessions what tools to use and how it works, meaning transferring money, buying, selling ETFs? So the actual use of the brokerage, right? Like, yeah, because each brokerage is different. I can show you in Qtrade. It'll help you a little bit. One thing I dislike about the broker, or not dislike, but just a fact with the brokerages is each one is different. And so, for example, Wealthsimple, you need to transfer money in before you're able to buy something, and not just initiate the transfer. The money has to have arrived and cleared before you're able to buy something in Wealthsimple. In Qtrade, I have 2 days to initiate the transfer of the money from my checking account before they start charging me interest. So I can buy something now, and then tomorrow afternoon, I'll initiate the transfer and they'll pull the money. So my point is, each one is different. So I can show you I can show you sort of how it works. even within one brokerage, mutual funds will work differently than ETFs. Mutual funds, you have to have the money in there first, because mutual funds you buy by the dollar, not by the share, but stocks and ETFs you buy by the share. And because that's fluctuating during the day when you can buy it, you don't know how much you'll actually be. So that's why they'll let you buy it, depending on the brokerage, they'll let you buy it first and then transfer the money in once you know how much you actually owe them. So, I mean, I can do a little bit. It's each brokerage will be different, and I don't think it's that complicated to figure out. So Daryl is asking, do you have tools we can look at to understand things like PE candles? So candles are more for day trading. I use it a little bit for options, as far as doing technical analysis and looking at resistance and support levels and so on. And I use some of the RSI and the MACD. We could certainly look at stocks. It's not really, as I said at the beginning, I would suggest for beginners not to do stocks, because like even the PE and its significance is like that's a half-hour session all on its own. I can show you in the brokerage sort of how it works, but it'll just kind of show it to you. That I do have. So first of all, I want to do courses that I want to put on the Canadian Money Talk website. I haven't recorded them yet. They're always 6 months out. You know how it is. And so this would be a basic course. Then I want to do an advanced course, which is what Daryl's asking about for stocks. And then I want to do a third one about options, because I have a very simple and basic options selling strategy for extra cash. And so that would be the one that I would sort of document. So, I mean, I can get into my brokerage and Deborah's asking, what are your thoughts about $10 monthly fee in Wealthsimple to purchase USA stocks? I thought in Wealthsimple you can buy Canadian US stocks for free. With US stocks, and this is probably what you're referring to, is they charge you a 2% conversion. And if you pay that $10 monthly fee, then I'm guessing they don't charge you the conversion. So, I mean, then that would just be a calculation. How much do you think you're going to be buying and selling on a monthly basis? And if that $10 is less than the 2%, then I guess it would be worth it. It would just be a calculation. So yeah, like the practical stuff of like how to transact. Yeah, I think I've done a couple YouTube videos where I kind of showed the transactions, but if you're not using Qtrade, yours will be different. And then each brokerage works differently, even at the level of, do you have to have the money in there first versus not? But generally, mutual funds, you're using dollar values. I want to buy $10,000 of this mutual fund. You'll have to have the money in there first, usually, because you know the dollar amount, and then whatever it happens to, it would get transacted overnight. So you would have to place the trade usually in the AM, and it would be done that night. If you place it in the PM, then it'll get done overnight the next day. And then it'll just calculate to multiple decimal numbers the number of shares that you have based on your $10,000. ETFs and stocks, you would generally you would say, I want 100 shares, and then it'll execute it. You can use something called the limit order. In fact, I would strongly suggest you use a limit order where it says, where you specify the maximum that you're willing to pay if you're buying, and if you're selling, the minimum that you're willing to take. And what that does is it prevents surprises, because on some stocks which aren't frequently traded, they're not liquid, they're illiquid. There could be somebody, the last trade was here and you want to buy it and you think I'm going to get it for here, but there's somebody who wants up here. And if you just do a market order as opposed to a limit order, you could end up paying this, and that would be a surprise to you. So limit orders are a good idea. And again, each brokerage will have those. They'll just be implemented a little bit differently. So I'm trying to think how I can show this to you guys without putting my account numbers on YouTube. So I'm going to stop the share. I'm going to get into my handy dandy okay, and now where's my share screen? Okay. Okay, so again, this is just Qtrade. So this is for equity, so this is for stocks. I can choose US or Canada symbol. So I'm gonna go with Algonquin. It founded great. Last was $14.80. So I'm gonna do 100 shares. So here's the limit price. So the most that I would want to pay, and notice that it says it's good through October 19th. I can put this out further out. That doesn't necessarily have to be in your brokerage. Obviously, nothing's going to get done today. It would be executed tomorrow. And I'm going to say, well, you know what? The most I'm willing to pay is $15. So if tomorrow, if Algonquin opens at $16, this will never get executed. Okay. If I do a market order, then that thing disappears, and whatever somebody's willing to sell it for, I would be buying it for. So that was that one. Mutual funds. So I'm gonna buy. So like I said, in dollars, right? So I'm gonna do $10,000. Oh, actually, so Qtrade has a very handy lookup tool where by fund company, and there's a shocking number of them. I wouldn't have thought that there'd be this many in Canada. So, let's say I want me some Manulife. So here's all of these. Here's the three. I hope you guys can see this. Here's the three letters, 3 digits, right? Load type, I'll get into in the third session. It basically means additional fees. I mentioned the the deferred sales charge. So no load means when you buy this, you can sell at any time. Is there any others? No, doesn't look like it. Okay. So yeah, here's the series. So series F would be the ones that have a lower MER, like I said before. You can get them in US dollars as well, and so on. So let's just pick one. Sure. Okay, so it plunks that in. Obviously, do your own research up ahead of time and review order. So it's saying $10,000. Dividend reinvestment gets turned on automatically because that's how I set it up somewhere else. You may be able to flip this off. Here's the fund description. Make sure you're doing the right one. This is what the last price was, and there's no commission, which I'm not sure why. I was expecting 695 there. You can also read fund facts, which is a two-pager, which I would suggest everybody to read before they buy anything. And then a couple of confirmations here, and this would submit the order, and then that would get executed tomorrow overnight. Yeah. Okay. Now where is
Thank you.
my? Yeah, you're most welcome. Now I would be curious because this is not an account where I get credit. I don't have $10,000 sitting in that account in cash. So I'd be curious whether it would execute this, because like I said, with mutual funds generally, because you know the money amount, you can transfer it in first, or they want you to transfer it first. With the get rid of this. With the stocks, I'm buying the quantity, and so I don't have to transfer the money in first. So yeah, it shows you how the stock performed throughout the day, while with the mutual fund there's no such thing, because like I said, it's always overnight. Yeah, oh yeah, it says down here, deadline to place mutual fund orders is 3 p.m. Eastern time to receive the current day's price. Anything after 3 p.m. Eastern may receive the next business day's price. So that's what I was saying. If you do it in the AM, it'll be the same night. If you do it in the PM, it'll be the next day. Okay. All right, we're hour 45. Let's where can we go? Okay, let's just do the next kind of page and a half, and we'll call it a day. It'll be about 2 hours. Everybody still awake? I okay. For those of you who know me from TikTok, I do 4-hour, 5-hour lives. I'm actually doing one tomorrow, so I'm not really tired after a couple hours. So when you're making personal decisions, sell when it's expensive, when people are greedy, buy it when people are cheap. Maybe don't sell your whole position, as I've said, because you don't know how far something's going to go. But when people are greedy and people act on emotion, they tend to keep investing and keep putting money in because they think it's going to keep going forever, and they just drive the price up where it's beyond the fundamentals. Let me bring the chat up again. Yeah, Daryl, yeah, so Qtrade and Questrade are different. Each of the major banks, including National, has their own discount brokerage. You have Qtrade, Questrade, Wealthsimple, Interactive Brokers. I think that's it. I can't think of any others. Some American banks might have, yeah, the major banks, for sure. Some of the American big banks might have Canadian branches, so you can get a discount brokerage with them as well. I had Qtrade first, and then I got Wealthsimple once they sort of, frankly, once they had a web client rather than me having to do it on my phone, which is how they started. And then Interactive Brokers has really cheap options fees, and so I got into Interactive Brokers for the options. And don't ask me what options are. So you're making your own choices to outperform the markets and all the experts, frankly. We all try it. We all buy individual stocks thinking I'm smarter than the guys who and gals who live and breathe it on Wall Street, and who've got master's degrees and all that. And we think we can outperform them. Give it a try. If you're doing it yourself, I said previously, have an investment thesis and compare your portfolio to that thesis. Don't do hot stock tips. It just hardly ever works out well. Well, so Daryl's saying, if I start putting things into my TFSA at Wealthsimple, then want to switch to Qtrade, should I just leave my investments in Wealthsimple or move everything to one platform? So from a visibility point of view, I noticed a huge difference once I got a second brokerage, and once I got the third, I have no visibility without looking in my Quicken, which is the tracking program totally separate from the brokerages, because I'm not going to log into 3 different brokerages to see how much of Manulife I have, for example. So if you can stay with one, I would suggest that, at least to start off with. Usually leaving a brokerage and transferring stuff out, it's not counting as selling it. So if you leave Wealthsimple, that TFSA can be transferred. It's called in kind. Transfer it over to Qtrade. And by the way, I'm not advocating Qtrade. In fact, I sort of have a negative view of it, and I've been slowly leaving it a bit at a time. And so when you leave them, though, they will charge you. The destination might pay you to cover it. So I just took my TFSA out of Qtrade and I went into Wealthsimple. So actually the complete opposite that Daryl is giving as an example. And Qtrade charged me $150, and then Wealthsimple covered it, and then gave me extra bonuses and stuff like that as well. So this is why I'm saying, have a plan, know what you're going to be wanting to do. Am I doing ETFs? Am I doing mutual funds? Am I doing them into an RRSP? One of the brokerages might charge you an annual fee if you don't have at least, I'm making this up, if they don't have at least 20,000 if you don't have at least 20,000 in an RRSP. So, sorry, I'm getting behind in the questions. So know what you're going to be doing in which account, and are you going to be doing options trading at some point? Then pick a brokerage that will sort of satisfy as best as possible. Which one is best? I think each one is different. Each one has a different business plan and how they make money. They have to stay profitable, right? Otherwise they'd go bankrupt and you wouldn't be anywhere. So they're going to charge you. Like, you're not going to get it for free entirely. Each one is different. And by the way, at the back here, I have moneysense.ca, highly recommended. They have best online brokers in Canada, and they sort of summarize each one. So I would look and, but you still have to cross-reference it with what you're going to be doing, right? Like they love Q-Trade, and Q-Trade and Quest Trade seem to alternate being the best each year. But like I said, I discovered that Q-Trade was just milking me for fees for the options trading. So I don't do that there anymore. So you have to choose which one is the best for what you want to do, and you need to know what you want to do before getting the brokerage. I know I'm not really answering the question, but that's just the way it is. So Daryl's saying I have old RSP and BMO, but trying to figure out if I should move things somewhere else. Not sure what BMO is going to charge me. Yeah, find out. Generally they'll charge you something. Where you're going will likely cover it up to, let's say, $200. So Q-Trade charges 150 bucks, but where I go has always covered it as long as you have, let's say, 50 grand, as long as you're doing a certain minimum, then they'll cover the 150 bucks, which I fortunately was transferring more than that. So phone BMO, ask them what they're gonna charge you. I mean, with an RSP, I wouldn't recommend selling stuff and then paying taxes on it by actually pulling it out. Like you would actually want to transfer the RSP probably. So see who will cover whatever BMO is going to charge you. Unless you hate them, I mean, there may not be any reason to, unless you want to have everything together. But like I said, there's some utility to having everything together, but not if you're going to be paying a bunch of fees. Luciano's asking, I am National Bank Investments, which is my first experience. I was told that my fees are lower when compared to, I don't know what NBDB is, because NBI starts with 250K. Not sure if that's better than Wealthsimple or others. I mean, all of this stuff is posted. You should be able to do the research. Most of the big banks seem to charge about that $10 a trade. I believe National Bank let you, as an introductory offer, let you do like 150 trades for free. If you're a frequent trader or if you have a significant amount, it'll come down some. Again, each one will be different. Wealthsimple, if you're self-directed and they're not running it for you, if they're not being your robo-advisor, then there's zero commission for trades. But if you want to do American stocks, which a lot of people seem to, then they'll charge you that 2% conversion, which, I mean, your bank will charge you 2% probably as well if you're converting Canadian dollars to US. But then when you sell it, then they charge you another 2%. But I do believe you can get like a pro version, which I think Deborah was alluding to, where that 2% goes away. I don't know. I have Wealthsimple for Canadian stocks and ETFs only. I also found Wealthsimple nor Interactive Brokers does mutual funds. Like I couldn't transfer my mutual funds in there. And Wealthsimple doesn't do corporate accounts, which my biggest single account is for my corporation. So, okay. There you go. There's the Google reviews. Daryl's saying, I found interactive trades on most exchanges, but fees can be high if you don't know what you're doing. I hear Quest trades higher fees than Wealthsimple, but better tools. If you don't use the tools, better to be on Wealthsimple. Yeah, that is true. I don't know about fees at Quest Trade at all. I know they don't charge you to buy ETFs. That's all I know about them. I've never used them. Wealthsimple has zero research. Q-Trade buys research from Morningstar and from Desjardins. and they have way more information. If you don't mind, going, if you don't mind going to Yahoo Finance and doing some research there, you can still use Wealthsimple for Canadian. I'd be wary of using them for American stocks because of that 2%. So suggest a dedicated session on brokerages would be great to go through remaining info in the Word doc. Yeah, so I definitely want to finish going through the Word doc in the next couple of sessions. The problem is with the brokerages, like each one is different, and like to take you through buying a stock in Interactive Brokers and in Wealthsimple, like once you sort of learn it in one, the others, you're like, okay, this field is a little bit different here and there, but like you have no trouble transitioning. And I think I sort of showed you, other than pressing the button to go buy it, I showed you everything about the brokerages. Each one will have a slightly different interface, but the meat and potatoes is going to be the same. Now, if you're actually wanting to go, how do I analyze stocks? That's the advanced version, and I've done a video on that actually fairly recently on the YouTube channel. And like I said, I want to do a course at some point. But like making the purchase is easy. And also don't forget, you can phone them. It's like, I don't understand this. Can somebody walk me through it? And they have tutorials and stuff like that. The purchasing stuff is easy. It's the figuring out what to purchase. That's that's the challenge. So yeah, I think I've sort of done a video on the how to analyze stocks, and I think with the brokerages, I think I hope I covered it. Like, I don't think there's very much more to it. Okay,
Yeah, that was okay. Thank you very much.
Oh, sure. Yeah. Okay. So here like this will take, and by the way, great questions. I appreciate it. So don't buy hot stock tips is, I think, where I was. If somebody is telling you at the water cooler at work or whatever about a stock, it's one that has gone up for them, and they're more bragging about it than trying to give you a stock tip. Because something that's doubled for them or tripled for them or quadrupled, could it keep going up? Sure, but is it a time to buy? Like, when it's super high, there's actually a much higher risk that it'll go down rather than that it'll keep going up. So what you want is somebody who says, well, I've got this stock that I really feel good about, but it's just got beaten up, man. And that's the one that you should be buying, not the one it's like, hey, this thing, like, I'm up 400%. This is awesome. It's like, yeah, they're just rubbing it in your face more than anything. That it's not a good buying opportunity. The other thing I wanted to touch on is day traders. Day traders define somebody who buys and sells the same stock in the same day. They use technical analysis, where they basically look at the patterns of the stock movements and basically other indicators to say, okay, from this point on, it's going to go up. But at the end of the day, they all liquidate their positions. The statistic is, and actually fairly officially, like a lot of brokerages will have a disclaimer that 90% of day traders will lose money in the long run. And again, I would argue that they're speculators more than investors, because you don't know anything about the company. You're just looking at the pattern of the stock price for that day, which I find, anyways. So I've never sold and I've never bought and sold a stock in the same day. So I definitely wouldn't recommend that. Or if you really want to try it, do it with 5% of your portfolio. Now somebody raised a hand. Daryl, did you have a question?
No, I just wanted to say about the stock tips. In January, someone pointed out that Activision was being bought by Microsoft for $95 a share. Right now, Activision's at $78, which means if you buy it at $78 and Microsoft buys it at 95, you immediately make a profit. I looked into it. It's not guaranteed to happen. And so if you buy it now, you might be stuck with it and it might go down. And it's only going up because everyone is jumping on it because they're waiting for Microsoft to buy it. And it looks like it's going to be years before it actually gets through a lot of government regulations before it actually gets bought. So your money might be tied up for like 2 or 3 years. And I
Yeah,
thought,
absolutely. And the thing is, it may just be a rumor. And I mean, this is how the meme stocks.
oh no, it was like I could find the Microsoft announcement. I could find the
Okay.
announcement on Activision. It looked like this looks too good to be true. And that's the other thing. It looks too good to be true. So I started looking into it. I started searching around. And that's when I found like professional traders talking about how this could be stuck for years, blah, blah, blah. And then I realized all the people on TikTok who are buying the stock up like crazy should have Googled a little more and found out that yeah, it was too good to be true. So yeah, if you hear something from social media, Reddit, TikTok, whatever, I've always found if I just search and I start Googling sites of things like RBC management or stuff like that, I find someone who's talking about it in a blog and pointing out why it's not actually what all the TikTokers think it is.
Right. Yeah.
It's hard to find that information. It's safer just to assume. Yeah, if you only heard it on TikTok and not from like a professional, it's probably too good to be true.
Absolutely. Well, I mean, it's just wrong information or possibly uh, conjecture or like even if it's an announcement. Uh, there was a mutual fund portfolio manager that made money on the difference between what the stock price is after an announcement of like a takeover and the actual takeover price. So let's say there's a small chance that it won't happen. And so the stock might, in your example, might go up to 90, and the $5 difference between the 90 and 95 is the chance that it won't happen and it'll drop back down to $78. So in some cases, people say, well, hey, I can buy it now for 90 and I'll make $5 in 3 months. And so they make money that way. And if it doesn't happen, then they lose out on a bunch of money. But
Well, it's actually valued at $60
okay,
and it's currently up to 78 because people are just buying it like crazy. But yeah, if it doesn't go through, it'll probably drop back down to 60
yeah,
because
yeah.
it's a fairly consistent 60 before the announcement.
I mean, for me, I would want to make sure that the stock is fundamentally sound uh, before buying it, just in case it doesn't happen. And if if it's overpriced as far as the amount of profit that they're making or what have you, then I wouldn't buy it because it may not actually happen. So it just depends on the kind of trader or investor that you are. I kind of look at it that way. So Deborah's saying, my mom had her Mac Computer Club years ago, and they said it's a good time to buy some Apple stock. They're coming out with this music thing, iPod. Yeah, it. I mean, you never know what's going to turn into something, and what isn't. I bought as a total speculation a stock in a company called Nikola, where they were going to make hydrogen and electric trucks, like 18-wheeler kind of trucks, and all they had was all they had was a business plan. They didn't They weren't making any revenues. They weren't making any profits. And the stock for me is down 80%. Now I only put like $4,000 in it, so it's not a big deal. But like every time I buy something on speculation or on expectations of future events, which may or may not happen, things usually tend to go badly for me. So now I'm like, is the stock paying me a dividend? Is it profitable? If the answer is no, like, I'm sorry, I'm not interested, but that's the type of investor I am. Um, there's certainly ways to make money in other ways in the market, which is why it's such an interesting facility. But yeah, I'm sure everybody has a story about the hot stock tips. Just in general, by the time everybody's talking about it, it's generally not the time to buy. The time to buy it is before everybody started talking about it. Daryl's saying, I worked at a semiconductor company that supplied Nokia 4 years before iPhone looked like they were going to be the future smartphones, but then they caught up in OS design and iPhone beat them. Yeah, I actually purchased Nokia for the G 5G thing, and they've just been flat. Nothing really happened. So some things work out, some things don't. This is why, especially if you're a beginner, just buy an ETF that follows the TSX, follows the S&P 500, and then another index for the rest of the world, and you won't have to deal with this if that's not your thing. Okay, so in general, if markets go down, right, this is sort of where we are right now. So what can you do? Well, you could sell, which is the worst thing to do, because the market's already dropped by the time you sell. So you're selling on the way down to the bottom, near the bottom. You're locking in those losses. It also throws your portfolio into disarray since you can't really plan and do it in an orderly fashion. For me to sell 60 stocks and 20 odd mutual funds on a hunch, that's like, I'm not going to do that. Now, what most financial advisors will try to get their clients to do is nothing. The market's going to come back. It always has. If you're thinking the market's not going to come back and it's going to go to zero, and you're thinking that we're all going to live in some dystopian Mad Max society with gangs roving around, then you got bigger things to worry about than your portfolio. The saying is, and sorry if you've heard this before, if you think the world is ending, you should be buying canned goods and ammunition. Otherwise, you should be buying stocks. That's kind of the saying. Generally, when the market's down, you should buy more. When prices are low, they're going to come back up. Stocks are on sale, so buy more. It's easy to say, hard to do. And the thing is, also, you will never find the market bottom. Never. You'll either be too early or too late. Back in 2020, I got lucky and I borrowed to invest, and I sort of got it right at the bottom. But I put a whole bunch of money in June, and it's gone lower since then. Absolutely no problem. I just part of the experience. Okay. This is a recent one. You make most of your money in a bear market. You just don't realize it at the time. So Shelby Davis, who I've never heard of. Okay, we had time in the market beats timing the market. Yeah, absolutely. It's just the experts can't time the market properly or on any consistent basis either. I just don't try. Generally, when I have the money, or if the market is down 20% or more from a recent high, once you hit a bear market, that's when I buy in. So that's my strategy. You guys develop your own. I'm sure you already have some. Some of you are experienced. Okay, this is going to be the last paragraph here. So my strategy for the stock market. This actually was a copied and pasted from an email that I sent to a friend of mine. I'm going to tell you guys a quick story. A friend of mine who just wants stock tips. He just wants me to tell him what to buy. He didn't want to learn, unfortunately, but he just wanted to make money. And at the time, back in 2020, I enjoyed Bank of Nova Scotia as a stock. And because I talked to a lot of people about investing, I basically made up a schedule of how I was going to start buying, and kind of did it multiple times. And I texted, a dozen people, I'm starting to buy. The market's down 20%. I'm starting to buy. And I texted him and I said, hey, I'm starting to buy. If you want Bank of Nova Scotia, as good as time as any. Oh, no, it's still going down. It's still going down. I'm like, okay. I bought Bank of Nova Scotia a second time, texted him, hey, I bought it a second time. No, it's still going down. Then the bottom, was it March 20 something, 23rd, market started going back up. And I texted him, I'm like, okay, I bought the third time, I'm out of money. And he goes, oh, but now it's going up, so I missed the bottom. I'm like, I'm gonna kill you. What are you talking about? So I wrote him an email, and this is sort of the cleaned up version. So I'm unable to time the market even reasonably, let alone perfectly. I will not be able to find a bottom to buy nor a top to sell. I stay invested at all times, putting spare cash into the market because the market goes up in the long run. So in 5 years, I will be up. I keep a small amount of cash as an emergency fund. If there's a drop of more than 20% in the overall market, I buy more using my home equity line of credit as an extraordinary purchase, which we've had 2 in the last 2 years. Because the market is on sale, it could go down more, but it's impossible to know where the bottom is. So I'm satisfied with the 20% discount when the market comes back up. So that's my strategy. Trying to time the market is next to impossible. Earlier, when I was talking about having cash in reserve in order to put more money into the market, I don't do that, because you're basically saying, I'm keeping this cash because I think the market's going to go down. That's a really tough call to make. And then you're holding this cash and you watch the market grind higher, and you're like, why didn't I put it in 6 months ago? And then you finally, okay, forget it, I'm going to put it in, and that's when the market goes down. So I don't want to put myself through that. And so I just sort of invest when I have the money, or I'll borrow to invest, which isn't for everybody, by the way. Question: saving for down payment versus investing while market is down. Well, I mean, if you want to buy a house, then I guess you have to save for the down payment. If you want to buy the house within 5 years, I wouldn't put the money into the market, like we said earlier. I mean, it just depends what you want. The market is down, but it could go lower. If you want the house, save for the down payment. If the house is an optional, then investing right now is as good as time as any, like I say. Not sure if I'm answering your question. So okay, so we went beyond this is now getting into tax territory, so we'll definitely save that for next time. Thanks very much for sharing your knowledge. Look forward to lesson 2, but a special lesson 3. Yes, I've been selling lesson 3 for some reason. I don't know why. So thank you everybody for attending.